Welcome back to another video. My name is Kyle and I suck at budgeting. We are going to continue with our stock market discussion. This is part 2. So I'm just going to give it to Charlotte, let her take it away and go for it.
All right. So last time when we were talking about the stock market, we were going through some of like those nuts and bolts of it. The stock market exchanges and stocks and bonds and mutual funds and all that kind of good stuff. Oh, I was like, okay.
I have a bolt somewhere right here.
Nice. So today we're going to be focusing on the stock market history, stock market fluctuations, those types of things. So I have a quote. Are you shocked that I have a quote?
Very.
So today's quote is, "The stock market is a device for transferring money from the impatient to the patient." And that is by Mr. Warren Buffett.
Margaritaville.
There you go. Different Buffett.
Oh.
So the reason I chose this quote is because it reminded me of my own investing experience when I first started and did not know any better. So back in the day when my husband and I were in our 20s, we actually did try to do a little investing. And I remember that we bought some single stocks. Now, last time we talked about that buying single stocks is a lot more risky than doing something like an index fund. But we bought single stocks. And within about, I think, a month or two, we had checked and the stocks had gone down in price. And we said, well, forget this. This is ridiculous. I put in $500 and now I have $400. Why am I investing in the stock market? This doesn't work. It's ridiculous. And we took our money out. And then we really never invested again until much later in life. At the time, I had no idea that it is normal and expected for there to be fluctuations in the stock market. So today, we're going to be going over some slides here in a minute to show you some illustrations of what you can expect. It reminds me of when we were talking about emergency funds in YNAB, and we were talking about the unexpected and then the expected that we have to prepare for.
Right.
So it's the same thing with this. There is zero expectation that you're going to put money in the stock market and it will only go up. It is going to go up and down, and it's going to be a roller coaster along the way, but they say the only people that get hurt on a roller coaster are the people who jump off. So we have to learn how the stock market works so that we can learn to roll with the punches here with the stock market. I have 2 things that people say all the time to me when we are talking about the stock market and investing, and they are these. They say, I am not going to put money in the stock market right now because it's at an all-time high. It's too high. I'm going to wait for it to come down. And then these same people say, I'm not going to put money in the market right now because it's crashing. And I'm going to wait for it to stop crashing. The irony here, right? It's both sides.
Yep.
They don't want to do it on either end. They only want to do it when it's perfect. It's never perfect. These are the people who never invest because they're always waiting for that perfect moment. Here's what I'd like you to do, Kyle. If you can pull up that very first slide for us. I have a series of slides here, and I am starting out in the most recent time period. So it says this is the last 2 years, but it's really all of 2025 and up to 2026 where we are so far, which is May. So there's a few things I want to draw your attention to. In this graph, it shows on the left-hand side that if somebody put in $10,000 on January 1st of 2025, it shows what would have happened to their money in the last year and a half. There are a few scary-looking things.
There are.
On this graph. We had 2 big dips in the market. It was the correction that happened for the tariffs back last year around April, and then this year surrounding the war with Iran. Now, a correction is when the market drops between 10 and 20% from its previous high. Now, at the time, these felt like big things. And here in this little span of this graph, they look like big things.
Yep.
They really look scary. However, corrections on average happen around once a year. And this actually tracks with that. So we have one in 2025 and so far one in 2026. Despite that, at the bottom, you can see circled in purple down there, that my $10,000 that I put in January of 2025 would have grown to over $12,000. So despite the fact that there were these two corrections, which I have to tell you, the news was screaming about every time it happened, we still made money during that time period. So I show this for a few reasons. One, to mention that you should expect volatility. The stock market in the short term is based on emotion, right? It doesn't like uncertainty. It doesn't like anything bad happening in the world. And it will react to that, even if it doesn't make sense. Because when I sit here and I think about, okay, last year I think it went down about 19% in 2025. Did really the value of all the companies in the United States go down 19%? No. It was just that at the time, people were worried about the economy, so they weren't willing to pay as much. Remember, we were talking about that auction and the buy and sell and supply and demand, all of that good stuff. So when people freak out, they either want to sell their stocks or they want to try to get it, basically they're afraid that they're going to go down, so they want to try to keep as much of their money as they can. So what happens is the things happen in the world, people start to worry, they sell their stocks, that makes the stock share price drop, and then people start to worry, and then it's a repeat, and it spirals down. Mm-hmm. So in this 2 years here, I didn't put that in the right place. All right. Yeah, seriously. Okay. So in that 2 years there, we had those two corrections. Now, what I'd like to do is go to the next one. And we're going to look here. This is a 10-year period. And I did a little purple block around the 2 years that we looked at already. Now, suddenly, when I look at it like this, those dips in that 10-year period don't look as scary, right? Because when in doubt, we zoom out, right? And now we're looking at a 10-year period, and we say, okay, yeah, those dips in the last 10 years, well, they felt really bad at the time, but in all actuality, if I look at where we've been in the last 10 years, even though they dipped down, we were still up quite a bit.
Yep.
On this graph, we have two new things that we're talking about. One is called a bear market. So there are bull and bear markets, which we'll talk about in a little while. But a bear market is defined as when the market drops by more than 20%. So corrections were 10 to 20%. And then a bear market is when it's 20% or more. And usually it's when there is pessimism about the market, about what's happening. So on this one, the bear market was in 2022, and it was during that really high inflation time. Interestingly enough, that's exactly when I retired. I retired in the middle of that bear market. And at the time, it gave me pause for a second. Oh my goodness. The stock market is going down, right? But we kept up with our plan because we knew how the stock market worked and that although it was down now, it would go back up.
Someone once said that we're now long-term thinkers.
Yes, we are long-term thinkers. Thank you for pointing that out. So, what's funny here is we have two two things on here. So we've got the bear market, and then we also have the COVID crash. So a crash doesn't have the same specific number that the bear market does, but it's usually 30%. But it's really characterized by a sharp decline. And the COVID crash was a beautiful example of a sharp decline. In 1 month, it went down, I think, about 34%. So it can be a crash even if it's less than 30%, if it is a sharp decline like that. Now, the bear markets only happen about once every 4 to 5 years, but the crashes really happen usually only about once every 10 years. As with anything, those are averages. So it's not like you can expect one every decade. For example, there was no crash in the 2010s. So you just never know when it's going to come. All right. So despite all of these things that happened, we had the COVID crash, we had the bear market, and then we had the multiple corrections. Now, I just pointed out 2 corrections on the previous one, but there are lots of corrections along the way. And it would be silly to try to label them all on here. I'm just doing some major things. But if we take a look at this, $10,000 invested January 1st of 2016 would grow to $42,000 today in that 10-year period. So that is a rate of return of 15.6%. Now, Kyle, what rate
That's a yearly return.
Yearly return. Yeah, that's not cumulative return. That's yearly return. So what yearly return were we using on our compound interest calculator the other day? 8%. So this, if we had pulled it up and we had put in 15%, well, it would show you that number was quite higher. And, we talked about the rule of 72, where you can kind of take numbers and run calculations on them to see how often your money would double. But 15.6% in the last 10 years. All right, so let's go to the next one. So I did the same thing. So I took that 10-year period, and I have it boxed out on the screen there. And then this does a 30-year projection. And we can see on here that we have a new term, and the term is a major crash. So a major crash is defined as a drop of over 50%. And the frequency is usually on average 2 to 3 times a century. Now, that is kind of hard to really say, because really in the 1900s, we had one major crash, the Great Depression. Now here in this century, we have had 2 right off the bat, right? We had one right around the millennium, the new millennium, thank you.
I'm a millennial.
There you go. The new millennial in the new millennium. One right around that 2000 mark, and then around the 2007, 2008 mark. So we can see on here that we had these huge drops, and yet, even after that, the market has continued its upward climb. So if you started with $10,000 in the first year of 1996, by now, 30 years later, you would have $197,000. And that is a yearly rate of return of about 10.4%. And that's usually where the stock market hovers most of the time, around that 10% mark. Now, when I look at this, I notice that, boy, that whole section over there where the major crashes are, it's looking pretty flat, right? The 2000s were considered the lost decade, where people pretty much ended that decade just a little bit higher than they were at the beginning of the decade, if they were not investing throughout that time. For somebody who was still working and was investing along the way, they got lots of different prices, right? They got high prices, they got low prices, and then when it came up. So there was actually money to be made in that lost decade for people who were actively investing. But even so, when we look at this, it's a little scary because that's the kind of thing where if somebody had retired right at the beginning of that, that would be a tough decade to retire into. Mm-hmm. The thing is, for example, when I retired, I didn't stop investing, right? So I maybe stopped adding to my investments, but my investments continued to grow. It's not like the minute you retire, you take all your money out of the stock market. You know, you may make some more conservative choices along the way, but your money still has many, many years and decades to grow, even after retirement. So we'll look at that a little bit more. All right, next slide. Okay, so, next one.
Why didn't they go?
I don't know. Okay, so now I have zoomed way out. This is the last 140 years. This goes all the way back to 1880. And I just marked two different things on here. The major crash, which was the Great Depression, and Black Monday, which was a big crash where I think that the market dropped, I can't remember how much it dropped that day, like 20% in one day kind of thing. These were, felt like the end of the world when they happened. But now I had to it was hard for me to even pick out where that Black Monday was. Now, obviously, the Great Depression was pretty significant, and we can see that there. But I'm zooming out here to kind of show you that sometimes the things, or a lot of the time, the things that we feel are like a huge deal at the time, as long as you have time on your side and you can stick to it, you can kind of continue through. Mm-hmm. So do me a favor. Can we go back one to that 30 slide? All right. Now, I have I was telling you guys in the last video that I had a friend who said that he lost a lot of money during the Great Recession back in 2007, 2008, and that he had yet to recover his money from then. So I look at a graph like this, and I say, how is that even possible?
Right.
I mean, at the time, the money would have been around the 10,000 mark, and now at the end of it, it's around the 197,000 mark. Right. So this is the difference between having single stocks and owning an index fund. All of these graphs that I'm showing you here today are based, they're referenced on the S&P 500, which is usually considered to be representative of the market in general. So the other thing I wanted to mention was Kyle was showing us last week about how, his investments have gone up since he switched how he was doing things. Well, I have had friends that have invested right at that point where the market starts to go down, and they're like, oh my goodness, this was a terrible thing. And then other friends who invest right as it starts to go up. So we're long-term thinkers, right? We have to just let it ride. And I'm hoping that these charts that we're showing today illustrate that although the market does go down at times, that it always, in the last history of the 140 years, it always goes up.
Yep. And if you look at, so going back to here where the Great Depression was, if you look at the numbers, it's within a 10-year span, it's about the same as what it was. The dip is about the same as where it was 10 years prior.
Yes.
So.
Absolutely. No, I love that you pointed that out, because usually, and we're going to look at another screen that talks about time periods, and yes, within 10 years, it's highly likely that you will make money by the end of the 10 years. We had talked about, on that very first screen, we had talked about short-term volatility, how the market reacts to emotion and uncertainty and chaos and all of those other things. When we zoom out here and look at the stock market as a long-term investing vehicle here, we can see that over time, the stock market grows based on things like innovation and productivity and growth and all those things. Because companies want to do well. They're always making new things. They're always coming up with a new technology and new innovation. And that is what kind of drives the stock market up. The other thing is that there is something called this is the top fallacy, right? Where people will say, oh, you know what? The market is an all-time high. This is the top. There's no way it's going to go higher than this. And this happens constantly. So just to give you a frame of reference, back when they first started tracking the S&P 500 back in the 50s, the share price for an index, the value of the S&P 500 was about $44. When that hit, 1,000, it was like, oh my goodness, it's never going to go any higher than that. I remember when it hit 5,000, oh my goodness, it's never going to go higher than that. As of today's recording, it's almost 7,400. So all along the way here on this graph, people thought that was the top. I need to get out. I need to stop investing. I need to, take my profits off the table. The people who do that are the ones that lose. I had another friend who I was explaining all this to, and she said, Charlotte, our investments never grew like this. But every time the market hiccuped, her spouse panicked and took the money out and stopped the growth. There was a situation recently where in March, the market was down quite a bit, and in April, it rebounded up 10%.
Yep.
Well, if you had taken your money out in March and you didn't know when to get back in, which nobody knows when to get back in, you missed out on all that growth.
Right. Yeah, I think the difference between that month, those 2 months for me was $5,000, I think. It went down I think it went down 3 and went up 8 for me, with my investments. So.
And it's hard when that happens.
Yep.
And this time it recovered quickly, but like we see in some of these other times, it doesn't recover so quickly. But it recovers as long as you're investing in a diversified manner.
And if you think about it this way, when the market is down, if you continue to invest, you're buying stuff on sale essentially.
You are. It is a great deal.
Yep.
It's kind of like if I went to Kohl's and they said, oh, these shirts are half off today, and I'd be like, no, I want to wait until they're full price again.
Right.
Like, that doesn't make any sense. Yeah, I'm going to buy it on sale. So I love that you added that. Terrific. Okay, so we have a few other slides we're going to look at. I'm not going to talk about them very long, but I'm hoping that if people are interested in them, they can just pause it and they can look at it. I'm just going to give you a few, you can go to the next one. I just want to give you a few other visuals.
Christmas.
To help you feel more comfortable about the market. So here is a graph of the stock market by year. So all of the green columns are the positive years, and the red ones are the negative years. So if you were to count them up, it's about 75% positive and 25% negative. Everybody focuses on the negative years. The media screams about it. Everyone says it. But really, 3 out of 4 years, on average, the market is up. Now, it's not every 3 or 4 years. It's not like every 3 years and then the 4th year it's down. But on average, it's down. It's down only about 25% of the time. All right, let's look at the next one.
It's a lot of numbers.
This is. The only reason I have this up here, this is a small version of the one we just looked at, a smaller time frame. But the numbers on the top are how the market ended the year. And I couldn't get one until I could only do it at the end of the month. So it says 5% for us right now this year. We're up about 8% right now. But it shows you what the market stopped or returned at the end of the year. And then the red numbers are what we call an intra-year decline. So at some point during the year, the market went down as far as that red number. So last year, the market closed up around 16%, but at one point, the market was down 19%, and that was around April of 2025. So when we talked about corrections happening once a year and bear markets happening every 4 or 5 years and crashes happening once a decade, they happen. They are expected. So we just have to ride it out as it goes. One of my favorite analogies that I've heard was when when winter's coming, right? And you have freezing temperature. So here in Ohio, Kyle and I experienced some freezing temperatures over the winter, but we know they're coming. Right? We don't know how long they're going to last. We don't know if it's going to be just a couple days or a couple months worth, but we know it's coming. So when we wake up that morning and the temperature is freezing, we don't freak out and say, oh my goodness, because the weather is freezing. Now it's just going to get colder and colder, and we're eventually going to die. It's never going to warm up. We're going to have to move. We're going to have to leave. We don't do any of that.
Right.
We say, we understand that this is normal and expected, and that it will become sunny again. So the stock market is the same way. It is normal and expected for you to have these fluctuations. On average, the market drops 14% each year. So a couple months ago, when the market was down here about 10% and everyone was screaming, that wasn't even as low as it averages. So there we go. Okay. Let's go to the next one. The next one is bull and bear markets. Again, not going to get into it too much, but bear markets are bad and bull markets are good. Somebody explained it to me one time where when, like a bull charges you and he takes his horns and his horns go up, right, to spear you. And when the bear's attacking you, his claws go down and he attacks you, right? Okay. So that's how I remember it. I think it's a fun way. But just in general, a bear market is when the market has dropped more than 20% and when it is trending downward. So those little orange parts at the bottom show you the bear markets, and the blue part is the bull market. The bull market isn't as succinctly defined as the bear markets, but it's when there's optimism and everything is on the rise again. So this is just yet another way to show you that the vast majority of the time, we are in a good market. Make sense so far?
Makes sense.
All right, let's look at our last one. Okay, our last one here is a historical frequency of positive stock returns. So this, I highlighted in purple. The most important part that I wanted to show you is that on a daily basis, it's about a coin flip, right? About 53% of the time, the market is up, which, you know what, sounds pretty crappy. Like that sounds like gambling to me.
Yep. But
the longer we go down in terms of our time frame here, like for example, the 1 year returns, the rolling 1 year return, 74% of the time. That's pretty similar to what we were talking about with that green and red one, where it showed about 3/4 of the time it was up. You mentioned about that 10-year period after the Great Depression. 94% of the time in 10 years, the market goes up. So all these things just to point out that what is happening in the stock market is normal. And I love what Kyle did back in March when his numbers went down for his investment accounts. And he took a beat and he sat there and he stared at the screen for a few seconds. Yep. And he said, well, that's the way it goes, and it will come back. And that's the attitude that we have to have. So when the market is going down, we just don't want to sweat it. If you have to, stop watching the news, because the news will send you into a panic. We do not want to panic and sell. This is not a get-rich-quick scheme. This is a long-term buy and hold situation. And like Kyle said, when the market is down, the shares are on sale. I always tell my kids this. They are in a great position. The best thing that can happen to them is that the market goes down because they can buy all these shares for cheap. Yep. Because really, when you look at it, if the market goes down, like let's say you had 10 shares at 500 each, and then the market goes down and now you have 10 shares at 400 each, you still have 10 shares. So when the market comes back, you have all those 10 shares gaining that amount. All right, so the resource that we have today for you, besides all that we listed here, is a book called Why Does the Stock Market Go Up? And it is by Brian Feroldi. So I don't have it with me. It's not one that I have purchased. I was just reading it on Libby. But Kyle said he'll stick it over in the corner for us. Yep. So that would be fabulous.
I'll do that.
So how do you feel, Kyle, about the recent downturn? So when you saw your money go down and now your money goes up, I mean, just how in general are you feeling about this?
I mean, in the beginning it sucked, but at the end it's like, I mean, I know it's going to change.
Right.
And it's not like I'm looking to pull the money tomorrow, so it doesn't really matter at this point.
Right. That was that whole make sure you're not investing money that you need,
Right.
Sooner than 3 or 5 years.
Yep.
So. I will tell you that in your investing careers, you're going to experience many corrections and bear markets and a few crashes along the way, and it will be okay. It will be okay. So I just would challenge your viewers to kind of think about how did they feel about the stock market, and how do they feel about investing, and hopefully they can keep all of these graphs and charts in mind when the you-know-what hits the fan. So, okay?
Sounds good.
All right. So next time we get together, we're going to be talking about the practical application of all this information. So far, we've just kind of been going over the why of everything. So next time when we get together, we're going to be going over the how. Because you can say, listen, it's all well and good. Okay, now I know about investing and compound interest in the stock market fluctuations, but what do I do? Right? So the next thing we're going to be going over is that practical way to take action and become an investor, just like Kyle. So that's it.
I invest. That's it.
That's it.
Awesome. Well, thank you so much for watching. We'll see you next time. See ya.